Well, good evening, everybody. It is 7 p.m. here on Thursday, which means it's Mortgage from a Treehouse time. Keith Pitch here, coming at you from my beautiful, beautiful treehouse. And good Lord, it was an amazing day today. 70 degrees, nice and sunny. We actually were able to, I sat on my back patio and just I did one of these, let the sun hit your face, warm you up. So, we've got a great show today. I'm super excited about what we're going to jump into. As coined last week, we're going to talk about the top 10 questions that I get asked that always come up. They typically come up in there's some purchase and there's some refinance, but in those different buckets that they typically come up. So I said, well, what better way than to show you guys or show you the questions, provide the answers, and give you guys a little bit more guidance when it comes to mortgages. And I'm sure if people are asking me, you're probably asking yourself the same question. Well, how does that work? Maybe I should do that. Maybe I shouldn't do that. So we're just going to go like David Letterman style, top 10 mortgage questions that I get asked, right? So let me share my screen here and bring this up. Here we go. Today's episode number 11 or 11, some people call it, the top 10 most asked mortgage questions. So, I've been doing this a little bit since 1999. Can't do the math anymore because that's over 20 years. I don't want to acknowledge that, but here we go. Let me click on that. So question number 10 always comes up when it comes to refinance. Always starts this way. Is now a good time to refinance? Question mark. And that's a very valid question. And I always say, if you listen to, I think it was show number 2, there's one correct answer to this. 99% of mortgage originators are going to go out there. Yes, it's the right time. Historically low rates. It's the best time. Blah, 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 blah. Right? It all depends on how long you're going to be in your house. Right? If your plan is short term in that house that you're going to go, you're relocating, you're going to a different place, you're going to transfer with your company to the East Coast, the West Coast, and you're going to sell the house, or there's going to be a big life change. Maybe you're going to downsize the house from your big family home down to a retirement home. No, it's probably not the right time to do that because there's upfront costs that you're going to incur. Somewhere between probably $3,000 and $5,000 worth of cost between title and escrow and appraisal and all that good stuff. So it depends, should always be the correct answer. How long are you going to be in the house? Going to the obvious stuff, rates are great. Rates are awesome. So maybe, yes, now's a good time to do it. If you're over maybe like 3.5% interest, yeah, now's the time to look at that so long as you're going to be in the house long enough that you're going to recoup the cost of actually doing that loan. So that is question number 1 that I get asked all the time. Is now the right time to refinance my house? So, great question, valid question, always the correct answer, or what you should be hearing back from mortgage professionals. If you're not working with me, I hope you do work with me. If you're not working with me, they should be saying, how long are you going to be in the house? That should always be the first question. Number 2. Well, number 9. Sorry, man. Counting up, counting down. This is tough. I give David Letterman mass cred, man. Anyway, so next question, number 9. How do you get paid? That's a personal question. I'm not going to ask you how you. Yeah, I am going to ask you how you get paid because that's my job. I have to. Okay, fair question, right? So how does a mortgage professional get paid? Great question. Here's how we get paid, guys. It's in the rates that we set. All of the mortgage companies out there, they set rates, and that rate includes the compensation paid to the loan officer. So there's no extra line item in there that you're going to be responsible for. So just know that the rates that a mortgage company set typically include the mortgage professional's pay. So it's all in there, nice and tight. Don't have to worry about it. There's no after the closing, you got to cut me a check or anything like that. It's all put into the mortgage. The other thing, folks, we as mortgage professionals, we can't get paid unless we do you guys a service, which means closing your loan, right? Not getting you pre-approved, not taking a mortgage application, not helping you with credit repair or any of that. We can't get paid for that, right? We can only get paid when the loan is made, right? So if any lenders out there are asking you for money up front before they made the loan, except for like an appraisal or a credit report, they can't get paid. They can pay the third-party vendors that are going to go out and get your credit report and going to go out and do the appraisal for your house. That they can ask for that money. It's bona fide third-party costs, but they don't get paid until the loan closes. So we're in it to win it. So we're right there with you. So that's how I get paid. It's already in the rate. It's how we set our rates to the street, the consumer public. It's all nice and tight. So that's how I did it. Question number 8. I've got great credit. My co-borrower, my spouse, my brother, my uncle, my whoever your co-borrower is, my best friend from college that we're going to go buy a house together and we're going to continue this roommate action forever, dude. Yeah. So I have good credit. My co-borrower doesn't. Can we leave them off the mortgage? That happens all the time, folks. I have 2 borrowers, sometimes 3 borrowers. We've got maybe 2 families that want to go buy a rental, or not a rental property, a second home on a lake somewhere, or a rental property, right? That still works. In the case, when it comes to lending, that we have a conventional loan, we sometimes and will take off a borrower if their credit isn't worthy enough to be on the mortgage, so long as the remaining borrower can qualify with income, down payment, and credit, right? So if all that works out, which credit wasn't the issue, right? The other party was the issue as far as their credit is concerned. So long as they meet those credit capacity and collateral, we're good to go, and cash for down payment. So no problems there. It's really good to have this conversation. Go out there and pull that credit and see what is possible. So many times I have folks come to me that, oh, my husband, my wife, my co-borrower, whoever that person is, they've been sitting on the sidelines for years. And the last few years is a bad time to be sitting on the sidelines. So they've just self-eliminated, said, no, I can't do it because I would love to buy a house with them, but they've got bad credit. I'm not going to do it. I've got too many student loans and they don't have any student debt. So long as the single buyer or borrower can qualify for the mortgage, you both don't need to be on it. So that's a really great workaround to help more people qualify when they think that they can't, whether it's too much debt or whether it's a bad credit score. So there's definitely ways to work through that. Just take the leap of faith and just go for it. Make the application. The worst case, any mortgage professional, worst case that we could do is say, no, you can't buy a house right now. Then we put together a plan of action, right? So yes, there's multiple times that we've taken borrowers on, put borrowers off because of credit. So it's kind of a, how are we going to make this work kind of scenario. It's not a Betty Crocker recipe that you got to follow during baking protocols that you have to hit half a teaspoon of baking soda, half a teaspoon of baking powder, half a teaspoon of this, a half a teaspoon of that. If you don't do it, your bread turns into nothing, right? We can play with the numbers and help you guys get qualified. So don't let that be your hurdle that's keeping you on the sidelines. Number 7. Sorry, this comes up all the time, you guys. Why are there so many documents to sign? Why are there so many documents to sign? I'm only getting a mortgage. I'm only getting $500,000, $1 million. We got loans in the pipeline right now for $2 million. Why are there so many documents to sign? Great question. And this is like literally my favorite law show ever, Boston Legal. For those of you that don't know it, you should definitely go out there and Hulu it or wherever it's at right now, whatever streaming app it's on, you should go watch Boston Legal. So that's a total side note. The reason why there are so many things to sign in your mortgage documentation. One, it's a legal binding financial instrument, right? You're borrowing 6 figures, sometimes 7 figures in a mortgage note. So there's going to be the mortgage note itself. There's going to be the deed of trust. There's going to be all of the rules and regulations. Thank you to our fine folks at the law firms and all the legislation that's been passed between Fair Credit, Equal Credit Opportunity Act, Home Mortgage Disclosure Act, HOPA for mortgage insurance, and the list goes on and on and on, and closing disclosures after closing disclosures. I've estimated that there's probably, through the mortgage, from the very application process all the way through the closing, you're going to sign in the neighborhood of about 250 to 300 documents in some way, shape, or form. Now, there's a silver lining. There's a silver lining. That's a lot to sign, right? The cool thing with technology is the majority of the stuff is e-signed, right? So we send you this cool little email that says, hey, Mrs. Borrower, you are ready to go get your application on. Here's your disclosures. Yeah, this packet is 95 pages long. Go ahead and read through it and apply your e-signature. This is good and bad, right? So good, it's super easy and convenient, right? You get to click the link, review the documents, tap, 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 or click, 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 apply a signature, apply an initial, apply a signature, boop, 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 click, 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 done, right? That's the cool thing. That's the good. The bad thing is you may or may not actually read it. So what I would definitely advise all of you is take the time to look through your mortgage documents. Super important. It's important for me and my team and our clients to make sure that you understand what you're getting, that there's no questions whatsoever left on the table. So make sure you read those documents, because at the end of the day, when you go to that escrow closing, that notary comes to you to sign your mortgage documents, you're signing a legal binding financial document. And I want the best outcome for you as possible. So that's why there's so much stuff to sign. There's lots of rules and regulations. There's been lots of lawsuits. So there you go. That's the real layman terms of it. I got to watch some more Boston Legal. You guys, that will happen tonight, and I'll report back next week. Next Thursday, we're going to have a little Boston Legal, maybe a little warm-up, 2 minutes tops. That's all I'm going to talk about. Anyway, number six. It's just getting better, you guys. Wait. What? It's blank. Why would you need that? What are you talking about? Does anybody know what I'm talking about here? This is hashtag bank statements, right? When we go through the documentation process, there's always that one page. That one page that's intentionally left blank. And we just got to ask ourselves the question, what if I told you that page with this page is intentionally left blank was in fact not blank? Because it's not. So this one's a pain. It gets us every time. We're through we're doing the pre-approval wrap up, and we get 5 pages of a 6-page bank statement, right? And at the bottom of the pages it says 1 of 2, or 1 of 6, 2 of 6, 3 of 6, so on and so on, right? But 6 of 6, when you're rummaging through your bank statements, 6 of 6 is blank. Oh, I don't need to worry about that one. I'm going to throw it over there. I'm going to pull out my phone. I'm going to scan this stuff in and send you 5 pages of a 6-page document. Boop, off to the mortgage company. And then I call you up, or I shoot you a quick email and say, oh, hey, about that. Thank you for sending over the first 5 pages. Everything looks great. Can you send me that 6th page? And it always happens like, wait, what? It's blank. Why do you guys need it? We need it because in addition to it being blank, it says 6 of 6, and we have to have the complete mortgage documentation in the file. And this is the one that just makes me pull my hair out. So here's the cool thing. Technology steps in again, and we can now digitally verify your assets. Boom. So what that means is we send you guys a quick link and say, hey, log into your bank account, transmit your transaction history for the last 60 days to your mortgage file, and then it turns off the link. And we use that as opposed to you chasing down your mortgage statements, signing into your bank account, looking them up through your file cabinet. If you still are doing file cabinets, cool, right? But what that allows us to do is to digitally verify your transaction history, your account statement, or your account balances, and it's all done. Clean, easy, out the door. Here's a little bit of pushback. People go, well, I don't want to link my bank statement. I don't want to link my bank account to your guys' application and what have you, because I just don't feel comfortable doing that. And here's what I remind everybody. You've given us your date of birth. You've given us your social security number. You've given us your mortgage statements and your pay stubs and your W-2s, and we're asking to verify your assets, right? At this point, I think we're a little bit past that point of resistance of linking bank accounts. I get that there's still a lot of concern out there, but financial institutions specifically have a huge barrier of entry as far as cybersecurity in linking interfaces to banks and what have you. So let me let you know this, that we take a snapshot and that's over. The link is a quick data push and that's it. It's not going past that. It's not this forever long, keep me signed in. Yes, remember my password. Yes, remember my computer kind of thing. It's just a quick data push. We're going to take a snippet of that 60 days and shoot it over to your mortgage file. So you really have nothing to fear. So that's question number 6. Moving right along, here we go. Question number 5, it's my favorite because this also gets people off the couch and into houses. I don't have 2 years at my job. Is that okay? Is it? Yes, it's okay in some certain cases, right? General rule of thumb, we want to see you in your job. Now, I'm going to change that because people think, oh, I need to be in my job. We want to see you in your line of work. So let's replace job with in my line of work for 2 years. So especially with COVID and what happened with people's employment, they've been out of jobs, they've been out of work, and they're returning back to work. There's a lot of leniency there in getting you back. If you're going back to a job and it's in the same line of work, there's been a little bit of a gap that we can explain through this COVID time. Great, don't worry about it. Get back to work, get that paycheck in your hand, and let's get your mortgage done, right? On the flip side, maybe you're just coming out of college and you haven't had time as an accountant. You haven't had time as a marketing consultant, but you studied accounting, you studied marketing consulting, you studied English, and now you're going to be a teacher, right? As long as you studied what you're going into, we can still use that, right? So it's not the same job. You can go from one job to another and have continuity as long as you're in the same line of work. Now, going from a programming specialist at, let's call it Tesla, to becoming the city librarian, that probably is not going to work unless you're becoming the city librarian's IT department, like staffer, right? That would work. But if you're going from IT to cooking, you're going to be a sous chef. That's going to need you in that line of work for 2 years, right? So those are the kind of changes that impact your mortgage qualifications, not just the fact that you haven't been on your job. It's not about the job, it's about the line of work. So super important there. I've helped so many people. They've come through open houses. I've seen them at my kids' soccer games. Like, oh yeah, I'd really love to buy a house, but I just haven't been on my job for 2 years. Well, what you been doing for the last 2 years? Oh, well, I was at this firm and then I moved over to this firm. And so I've been here, but I haven't been here 2 years. You can buy a house. Super powerful stuff. Number four, show me the money. Where can I get my down payment? Hey, can my parents give me money for my down payment? Absolutely. Absolutely they can. As long as they can document that it's in a bank statement, right? Can't just be cash coming out of the mattress or out of the gun safe or what have you. It's got to be actually in a bank account, right? So yes, this is a great conversation to have because this speaks to a lot of people's preconceived notions and not understanding where money can come from for down payments. Money can come from a lot of different places. They can come from down payment assistance programs. They can come from not only your parents, but other relatives, aunts, uncles, grandparents, godparents, a lot of different places. The other thing that it can come from nonprofit organizations such as churches and home buying grant programs. So there's a lot of opportunity out there. And I would say this to that, similar to the credit conversation. If down payment's your hurdle, make the application. Let's see what we can do for you. You may be hugely surprised that you'd be able to buy a house. I know when pre-COVID, when I was hosting first-time home buyer classes, I love doing them in person. And I guarantee you, 100% of that class came in with this preconceived notion that, they thought more likely than not that they weren't going to be able to buy a house. I'll give this class a shot, but I don't think I'll be able to buy a house because I don't have the down payment and probably can't do it anyway. And they walk out of that class, 75, 80% of them walk out of that class able to buy a house and know it. And the power that they walk out of that class with, awesome. So what I'd say is always ask the question, take the shot, make it happen. And the worst case scenario that we could tell you is not right now. Let's put together a plan of action to get you there. So yes, down payments can come from a plethora of different places, and parents are definitely one of them. How do I calculate APR? Why is that important? Okay, the best part of this question, and I laugh every time I think about this question, I would venture a guess that probably 7 out of 10 mortgage professionals couldn't calculate this by hand, right? So I'll show you. I'm going to show you guys the calculation. Super simple right here, right there. There you go. That simple. Yeah, that's how you calculate APR. No, it's really not. I have no idea what equation this is. I found it because I wanted to put some complicated equation into the presentation to make it seem like APR is this magical math unicorn running across your mortgage disclosures when it's really not. Here's what it is. APR is trying to show you what your real cost of funds is, right? So let's set the table and walk you guys through how APR is calculated. So here's the loan scenario. You got a loan at $600,000. Doesn't matter if purchase or refinance. The APR costs, so the closing costs associated with this loan. So escrow and the underwriting fee and discount points and anything that is related to APR fees, $6,500. Your note rate is 3%. So we take right here, we take the mortgage principal balance of the $600,000 here, and we put we calculate out the 3% interest, and we come up with that mortgage payment of $2,529, right? So now we keep the same payment. Here's where it gets complicated, right? Keep the same payment. Fast forward to the next slide. We subtract out the cost of the loan, the APR costs, right? So we pull out that $6,500 and we keep the same payment. So we now have a new loan amount. Now, if we throw this new loan amount of $593,500 into our mortgage calculator, and we say, hey, we keep the same payment at $2,529.62 on a 30-year fixed, what is the effective interest rate on the money? Boom, done. That's how you calculate APR. That's where it comes. So it's backing out the costs, saying if I have the same payment, backing out the cost on that new principal balance, what does that look like as far as an effective interest rate? So I want to flip over here really quick and go back to a little bit what I was talking about earlier. I'm going to make this bigger because it deserves to be bigger. You guys know me. I am a junkie here when it comes to looking at the numbers. So I wanted to share this with you because I am not unlike you. I want this bigger. Hold on. Technical difficulties. There we go. Plus, let's make this bigger. Why did it switch views on me? Anyway. Okay. So there we go. There we go. Okay, so I got this solicitation. It's on a 15-year fixed right here with 2 points in discount. So it's saying, hey, your interest rate on a 15-year fixed, 740 credit score with a 548 $100 principal balance at a 1.99. The APR is 2.292 on a 15-year fixed, and here's your payment, right? So I was like, wow, that's super cool. That's a big buy down. And it really looks appealing, though. It's exciting to say, oh, wow, I could get 1.99% on a 15-year fix. That's awesome. But here's where the rubber meets the road. What if you're not going to be there for more than 4 or 5 years? What's your break-even point? You know, so 2% on $548,000. If we go look at closing costs, you guys, that's $10,430. Right? It was the discount points are 1.904, right? So that's $10,000. The question then is, in 5 years, would you recoup it? Right? So you got to look at the long term, right? You're going to spend this $10,000 up front to save and get the 1.99, but does it really make sense, right? So here's a 1% discount, right? Discount points are cut in half, and then here's 0 discount. So we look at the payment breakdown. Yeah, the principal balances are not that different, guys. The cost savings is not that different. So yeah, if you want to flip over maybe from an adjustable rate mortgage, or you want to be aggressive on a 15-year fix to pay as much principal in the next 5 years as possible, great. That's a great way to do it. But for a cost savings of $130 a month, is it really worth that $10,000 up front? So you got to remember that $10,000, this APR, this cost of funds is spread out over the life of the loan. It's saying, hey, if you take this to full term, your effective cost of money is 2.92%. So I would just make sure that you guys understand how that all works. Let's look at one other thing. Here's the 15 years over the 15 years. You're going to pay $10,000 up front to only pay $86,000 of interest on the loan over the life of the loan on this scenario number 1 to get 1.99. And then if you did 0 points, you're going to pay $110,000. So what really is that opportunity cost? $25,000. You're going to save $25,000 to pay $10,000 up front. So that's kind of those questions that I ask. The other question that I always like to ask is, there's always the opportunity cost of what you can do with that $10,000 if you put it into some sort of other asset, right? What if you put it into the stock market? What if you did some other investment vehicle? What if you have kids? What if you went out and bought another house with it? So there's lots of questions to dive into, and it's about building a strategy. So APR, yeah, APR is one of those fun, magical things. Going into busy season, this brings us to another magical thing. Going into busy season, question number 2 asks, how long does the appraisal take? And I have to say this, appraisals are a funny thing. Appraisals, through the span of the year, turn times go up and down, right? So right now we're heading into the busy buying season. We're right in the middle of it, actually. We're finishing up April. I cannot believe that. We're finishing up April and rolling into May. And May is really kind of the apex as far as the volume, right? So we start the year January, we start down here, we kind of tick up through late February, March, sees a really good tick up, and then April kind of takes off, and then May we peak up, and June we're way high. Well, I'm out of the shot, sorry. We're way high, and then we just kind of plateau through September, and we kind of fall back down and go to holiday season mode, right? So appraisals during peak times, last year, let's use last year as a result, or as an example. Last year, we were seeing appraisal take somewhere between 2.5 to 3 weeks to come back. During the non-peak months, I don't want to say slow months, but the non-peak months, we're we're seeing appraisals come back in 5 to 10 days, right? So it really depends on the time of the year and location. Location. The more rural, just a general rule of thumb, the more rural the property is, the longer it's going to take to get an appraisal out there. The more unique the property is, the longer it's going to take an appraiser to get out there, right? And to take that transaction. So just keep that in mind. It's always a great question to ask as you're gearing up to write those offers, as you're making those refinance applications, talking to us and say, hey Keith, how quick can we get an appraisal back? Expectation setting is the key of the game. Super, super, super important. So finally, that takes us to our last question and the number one question that I always get asked. What? I don't need 20% down to buy a house? No, you're lying. What? Circling back on it, I alluded to it with the parents. You don't need 20% down to buy a house. I love this question, or it's not necessarily a question. It's more like a I'm dreaming, pinch me moment. I'm dreaming, pinch me. What? I don't need 20%. A lot of folks have this preconceived notion. The internet, I hate you for sending this out that you have to have 20%. Here's what the headlines typically read. The internet says, home buyers must have 20%. ... Little small print. Or they're going to pay mortgage insurance. You don't need 20% down at all, right? So there's lots of options out there for folks that could possibly qualify for zero down options through down payment assistance, through the VA, through USDA. And then there's small down payment options with as little as 3% down. So if you're thinking about sitting on the sidelines and waiting a little bit longer to get that house because you haven't saved up 20%, please stop. Please lift yourself up out of your chair and go to my website, make your application, make it happen, because guess what? You do not need 20% to buy a house, right? Start the process. Know what you can do, because knowing what you can do is powerful. It's super powerful. So 5% down, 3% down, 0% down, those things are possibilities. But none of it's a possibility if you don't start the process. Don't ask the questions. So feel free. Don't hesitate to ask me any questions. Hit me up, DM me, drop it in the chat here. Say, hey, Keith, I got this question. Do you think I could buy this house? Do you think I could do whatever? You guys, if I can help more people get into housing, stop renting, build wealth, show them what it means to buy and have a house, and again, the power of real estate, pay down the mortgage and take the benefit of appreciation, that my friends is powerful. And that's the education that we need to be spreading. That is how we can help everybody out, is to help people build wealth. And that's what I'm super passionate about. So this is my number one question. Wait, I don't need 20% down to buy a house? So I hope you guys have found this awesome and insightful. And if you have, by all means, please give me a thumbs up. Let me know. Like it, comment, share it with your friends. Hey, check this out. Top 10 mortgage questions you should probably know. Super great guidance, if nothing else. So look forward to seeing you guys next week. Please do me a favor. Help me get the word out and spread this around. Share it, like it, thumbs up it, comment. I'd really appreciate it. And again, next week, we're going to jump into a new topic. And that topic, episode number 12, no doubt, pull the cash out, right? There's a lot of fear out there, and there's a lot of misunderstanding about using your house to pull equity out to build financial stability. I mean that through a cash out refinance to help consolidate debt, to help do home maintenance and renovations. We're going to talk about all of that next week and how you can make a more powerful financial decision with the cash out refinance. So if you have any questions in the meantime, by all means, hit me up. Let me know. We'll catch you guys next week for Mortgage from a Treehouse, and enjoy the weekend.